What is an expense? Expenses are the cost of assets consumed or services used. Expenses then branch off to liabilities such as accounts payable, interest payable, wages payable, sales tax payable, and income tax payable. On an income statement, expenses directly follow revenue. When recording expenses on the income statement, you want to have the type of expense followed by the amount in a separate column known as the debited side. Expenses let us know how much of our revenue we are spending. We cannot have an income statement without showing not only our gains, but also our losses. By recording expenses, we can create our net income. Expenses also allow us to create our retained earnings statement, which we use on our balance sheet. Lastly, expenses affect stockholders' equity, which we will talk about later on in the video. Expenses causes equity to decrease. There are many different types of expenses. Two of the ones that I'm going to discuss, one being operating expense. This is the cost to operate a company. The second being non-operating expense. This is the cost from activities that are not directly related to day-to-day running of a company. What is net income? I mentioned it a little bit earlier. Net income is the goal of the income statement. Net income is calculated by subtracting total expenses from total revenue. Net income is used to calculate the retained earnings, which we will get to a little later, which is then used to set up the balance statement. What are assets? An asset is an item that a company owns with the expectation that it will yield future financial benefit. Assets is a section of the balance statement. Inside assets is where all the details will be. What is current assets? Current assets are assets that a company expects to convert to cash or use up within 1 year or the operating cycle, whichever is longer. Some types of current assets are cash, investments, receivables, inventories, or prepaid expenses. The current assets category on the balance sheet represents assets that can be consumed, sold, or used within 1 calendar year. Current assets appear on the asset side of the balance sheet, which provides a periodic snapshot of a company's financial position. Only assets that can be converted into cash within 1 year are classified as current. Current assets are often used to measure a company's short-term financial health. There are many categories of current assets. So what are they? The first one that we're going to talk about is cash or cash equivalents. This includes cash on hand, currencies, and other short-term assets such as checking accounts and treasury bills with maturity dates of 3 months or less. Number 2 is marketable securities. These are short-term investments that can be converted to cash such as money markets and certificates of deposit. The third one is accounts receivable. These are cash payments owed to the company by its customers for products or services already delivered. The fourth one is inventory. This is the raw materials that go into making a product, as well as units in production and finished goods. And the last one is prepaid expenses. This is the value of goods or services that the company has paid for in advance but not yet received.
So, what is equity? This is the claim of ownership of assets. This includes the money that a shareholder can receive if all the company's debts are paid off and its assets are liquidated. Now, that's quite a mouthful, and in simple terms, this is all the money that, if it's put down into its simplest form, which is cash, that is available for use within the company. Yet, there are more complex forms of equity, such as common stock, preferred stock, additional paid-in capital, retained earnings, and treasury stock. Common stock is which shares entitling their holder to dividends that vary in amount and may even be missed, depending on the fortunes of the company. We have preferred stock. That's stock that entitles the holder to a fixed dividend whose payments takes priority over that of the common stock dividends. Then we have additional paid-in capital. That's the excess amount paid by an investor over the par value of a stock issue. Then there are retained earnings. The cumulative net earnings or profits of a company after accounting for the dividend payments. And finally, we have treasury stock. A treasury stock or a reacquired stock is a stock at which is bought back by the issuing company, reducing the amount of outstanding stock on the open market. So the next question is, how is equity used and where? So the standard equation for equity is assets minus liabilities. The basis of equity is what we own minus what we owe. And here's where you can find it on the balance sheet. As you can see on the sheet, you have assets, liabilities, and owner's equity. And under owner's equity, you have common stock, paid-in capital, retained earnings, total stockholders' equity. And then you have the culmination of the total liabilities and equity there on the sheet. And it's also labeled with the red arrows. So now that you know what equity is, how equity is used, and where you can find it on the balance sheet, the biggest question we ask is, why is it important? Well, it's important because it represents the value of an investor's stake in the company, and it's represented by the portion of its shares. Without equity, there wouldn't be an establishment of ownership, and money would just flow freely without any cause in the market. Having equity allows the potential for growth in any and every company. Now, the biggest thing when you're learning a new topic is figuring out how to apply it to current day situations and something that you would actually use it for. Now, some everyday examples of equity would be household equity. Now, this would include a house, a loan on a house, and a motorized vehicle. Now, following the examples on the page provided, you can use the equation mentioned earlier, equity equals assets minus liabilities. The ending equity amount ends up being $100,000. Now, if you follow, the value of the house is $200,000, the motorbike is $5,000, and the loan on the house is $100,000. Now, as you continue going through the sheet, the total end up liabilities, because of the values and what applies as assets, liabilities, and equity, the total liabilities end up being $100,000.
For these slides, I'll be talking about revenue. Revenue is the amounts earned from the sale of products and other sources. Types of revenues you might find will be sales, service, and interest. Revenue has a very big importance. Revenue will always be the first entry in your balance sheet, and without revenue, then your balance sheet will be incorrect, which may cause problems later when using other concepts. In this example shown, revenue is in the income statement. The type of revenue is service revenue. Service revenue will be the first part of your income statement and will be used to find your net income. As you can see in this example, revenue serves as a building block, your very first thing that you have to look for when trying to build an income statement. In these slides, I'll be talking about income statement. Income statement is reports, revenues, and expenses during a specific period of time, and the time may be dependent on your company, which is very important to remember. The importance of income statements. After completing an income statement, you can use the net income for a retained earnings statement for the balance sheet. The income statement becomes a stepping stone to create a balance sheet. An example of an income statement. In the example, there are many parts to an income statement. Parts included could be revenue, which is the amount of money made, expenses, which is the cost of assets used, total expenses, which is the total amount of expenses, and your net income, which is the ending amount after subtracting expenses from revenues. So in this example, they have different types of revenues, which can be income and sales. Well, for expenses, they talked about the cost of goods, wage, rent, interest, different types of expenses that might come up for a company when they are trying to make a product or get to that end goal. And of course, if you subtract your total revenues and your total expenses, that's how you find your net income, and that is an income statement.
The next portion of this project that we'll be discussing is liabilities, and we'll begin with current liabilities. Current liabilities are sometimes called short-term liabilities, and these refer to any obligation that a company is committed to pay within the upcoming year or operating cycle, whichever one is longer. And included in this is accounts payable, salaries and wages payable, notes payable, interest payable, and any income taxes that are payable. One thing that's important to include in current liabilities are any payments that are going to be made within the next year on any long-term obligations. So this could be, for example, if a company purchased a building, they're expecting to make a payment on it within the year. This could be included in the current liability section. Next, we're going to discuss the importance of current liabilities. And these liabilities are really important because they show a company how much they can expect to spend or to owe in a given year or operating cycle. If a company doesn't account for its short-term liabilities, they'll quickly find themselves in financial trouble because they haven't accounted for things that they're going to have to pay within the year. And current liabilities are also part of the bigger picture of both the basic accounting equation and the working capital. The basic accounting equation assesses assets by the equation of assets equals liabilities plus stockholders' equity, and the working capital equation is another equation where liabilities are used, in which working capital equals total assets minus total liabilities. And both of these equations are used to assess the financial health of a company. And so as current liabilities are both in both of these equations, it's really important that the current liability section is done correctly and that it is assessed by a company in order to share and know their financial health. So if we look at an example of current liabilities, in this example on the balance sheet, we see that current liabilities is under the liabilities and stockholders equity section, and that current liabilities is its own subheading. And within this current liabilities section, notes payable, accounts payable, unearned sales revenue, salaries and wages payable, and interest payable are all there as being accounted by this company. And each of these things add up to then show the total current liabilities, which will then be added to your total long-term liabilities, which will make the total liability section. Next up is our long-term liabilities. And long-term liabilities are any obligations that a company expects to pay after 1 year or after one operating cycle. So these things can include bonds payable, mortgages payable, long-term notes, lease liabilities, and any pension liabilities that a company may have. The importance of long-term liabilities is that it looks at a longer-term view of a company's financial situation. It plays into the total liabilities portion of the balance sheet, and it's very similar to current liabilities as it impacts how much a company believes it has, and if it's done incorrectly, it can have negative impacts on both the financial statements and how an investor or someone assessing the financial health of a company will assess this company as performing. So if we look at an example of a long-term liability in the balance sheet, we'll see that long-term liabilities is its own subheading under the liabilities and stockholders equity section, and that under long-term liabilities, in this situation, mortgages payable and notes payable are accounted for. So those two things are added up to equal a total long-term liability, and then that total long-term liability combined with the current long-term liability shows a total liability for that company to expect to owe. The next thing that we're going to discuss is the order of financial statements. And this is a very important section because there is a specific order that needs to be followed in order to input the financial statements correctly. And so the order is as follows. First comes the income statement. Second is the statement of retained earnings. Third is the balance sheet. And fourth is the statement of cash flow. Although we don't cover that in this course, that is the final statement that will be used by a company. Why is order important? Order is extremely important to complete these statements because one statement feeds into the next. And so, as we said, the first statement is your income statement. And so the income statement uses revenues and expenses to show a net income. This net income then is used in the statement of retained earnings, which will then produce dividends and retained earnings. And so those dividends and retained earnings, along with some data from the income statement, will show and be used in the balance sheet. So the balance sheet will then share everything that is going on in a company, including assets, including current liabilities, everything that is being done. But if one statement, for example, if the income statement is done incorrectly or if it's missing certain elements, then the final balance sheet will be incorrect. And so this will result in an inaccurate account of a company's cash flow. And this can have really bad implications as it can lead to investors not wanting to invest, or it can lead to really legal and financial trouble with the IRS. So you want to make sure it's really, really important for a young accountant to know that order is important and to not move on from one statement to the next without making sure that everything is done correctly.
Hi, my name is Jaleesa Alexander, and I'm first going to be talking about retained earnings. What are retained earnings? Retained earnings are the cumulative net earnings or profits of a company after account for dividend payments. The word retain explains how the earnings were not paid out to shareholders as dividends, they were retained by the company. This is the way that the business is able to employ new workers, raise the pay higher, and upgrade equipment. The net income from an income statement comes into play here. How to document retained earnings. Retained earnings are the outcome of subtracting the net income from the dividends. When you are given a scenario, the earnings from January 1st will be specified as well as the net income. Here is where you will put the retained earnings. Here I will explain the entirety of a retained earnings statement. In the previous slide, I showed where retained earnings are documented on the statement. Below it is the add section. Here is where the net income would be added. This is why the income statement is important, because the information is gathered from it. The total from the retained earnings and net income would go here. Next is the less section. This is where the dividends are documented. It is less because the dividends are taken away to get the leftover profit. To get your earnings for the end of the year, you must use this equation. Retained earnings plus net income minus dividends. Remember that if your net income is a loss, subtract it from your earnings instead of adding it. This is an important step. Why are retained earnings important? Retained earnings are one of the beginning steps to creating a balance sheet. If the earnings for the ending period of your retained earnings statement is not completed, then you cannot start on your balance sheet. Dates are also important. Be sure to check if your scenario gives you a date for the beginning of the month. If so, you would need the earnings for the end of the month to be used on the balance sheet. Now let's talk about long-term assets. Long-term assets are assets that the company can use to their advantage for longer than a year. This can include land or buildings that a company is not currently using in its operating activities or long-term notes receivable. Other examples are equipment owned, software developed, patents, copyright, and property. These assets can be tangible, which are physical, and intangible, which cannot be touched. When there are changes to long-term assets that can be observed on a company's balance sheet, this could be a sign of liquidation or capital investment. A sign of capital investment is when companies invest in their long-term assets using revenues to make more asset purchases designed to drive earnings in the long run, whereas a sign of liquidation is when companies will sell their long-term assets to pay off debt or meet short-term operational costs. Why are long-term assets important? Data on companies' long-term assets is important to help make financial reports, business valuations, and analysis of the organization's finances. Long-term assets are needed on a balance sheet along with current assets to help determine the total cost of assets that a company has. How to record long-term assets. When recorded, long-term assets have the same price as when it was bought, so the current value may not be the same as if it was purchased a couple years ago. Long-term assets are recorded after all current assets are totaled. Once you calculate all of your long-term assets, you will then add them to current assets to get a total of all assets. Depending on how difficult or simple your balance sheet can be, some long-term assets will have their own section as shown below.